Well, the Fed has cut interest rates, but what now? Hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 24th of September 2024, and you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for you. So, it's a tale of two central banks at the moment. Last week we saw the US Federal Reserve cut interest rates by a surprisingly large 0.5%, 50 basis points, and today we obviously had the RBA keep rates unchanged. The move in the US was probably a little bit surprising, although by the end it was expected by many that the Fed would start the cutting cycle with a large move. They've cut rates by 0.5%. Historically, that would be seen as a crisis move, a move designed to avoid a catastrophe or designed to, soften the economic downturn of a sort of large economic shock. Recent economic data from the US has been pretty strong, and so the move looks a little bit surprising. Some people say, it might have panicked the market. Some people say, maybe they know something we don't. And some people believe the sort of line that the Fed's put out there, and that is, the economy's in a good position and that the move is designed to keep it there. I think the US economy is fairly strong. I mean, some data has been mixed, but overall, I think the data is probably holding up a bit better than expected. There have been a couple of weak jobs reports, but outside of those weak jobs reports, most of the data has probably been stronger than expected. I actually think the market's fear is completely misplaced. The US economy is fairly strong, and in large part that's due to extremely aggressive fiscal spending. US government is running very, very large deficits. They're not slowing their spending at all, and that is helping to keep the economy strong. However, on the flip side of things, I think it is also helping to keep things fairly inflationary. If you look at the US inflation data, all of this year inflation hasn't fallen up until maybe last month. And you could attribute some of that maybe just to oil prices coming down more than anything. We've seen risk asset price inflation very evidently. And I suspect there's a fair chance we see inflation, consumer price inflation, tick back up a little bit. If that is the case, I think such a move from the Fed is going to look silly. We risk a repeat of what we saw in the 1990s, where Alan Greenspan started cutting aggressively, only for inflation to rebound. And I would not rule out a situation like that occurring in the US this time around as well. Obviously, we're going to have to wait a couple of months to see if that's the case. But like I said, huge amounts of fiscal spending. The Fed starting with a pretty aggressive rate cut. I wouldn't rule out a rebound in inflation. On the flip side of things, we got our RBA, which is playing a much more cautious wait-and-see approach, and obviously it's true that our inflation is remaining a bit stickier than theirs. We've seen recent strength in the Australian jobs market, not huge amounts of strength. Unemployment's held right around 4.2%, but we did see more jobs created than expected. Again, part-time jobs, full-time jobs disappointed, but the labour market's holding up well enough, not to start cutting to shore up the labour market. Australian economic growth remains anemic, 0.1% quarter on quarter for a couple of quarters now. If not for the huge immigration-driven population growth, we would be in recession, but it seems that that's neither here nor there for the RBA. The big news today was Chinese stimulus. So the Chinese government cut certain lending rates. They've allowed certain assets, debt assets, equity assets to be bought by Chinese government institutions and Chinese government-backed businesses and brokers. And that was pretty heavily applauded by the Chinese stock markets today, both in Hong Kong and on the mainland. That did push up our iron ore miners. In fact, they've actually been rising for a couple of weeks now in anticipation of this move. And that is despite iron ore touching a multi-year low on Monday, but I'll touch on that in a moment. The Chinese stimulus measures were, like I said, applauded by Chinese investors, although part of that is almost certainly Chinese authorities instructing brokers and businesses to buy to make it look, like their stimulus measures were well received. Regardless, it did trigger buying in our own market. The Australian XJO jumped 30 points after the measures were announced, and US futures came quite a bit off their lows as well. Whether or not that's going to be enough to stop the economic malaise in China, I'm not too sure. I think they'll probably need some wider reforms to really, increase the long-term trajectory of the Chinese economy. I'm not sure just cutting, lending rates will, and sort of allowing debt buybacks will trigger, that sort of meaningful economic progress that they need. Keep in mind, and sort of further to this point, it seems that a lot of people have a very simple lower rates economic growth, quantitative easing, economic growth, lower rates, good economic outcome. The evidence for that is really quite mixed and not necessarily supporting that case. The Japanese economy has seen 3 decades of pretty much no growth in economic activity on the back of very, very low interest rates, on the back of, periods of quantitative easing. The US economy saw pretty lackluster growth coming out of the GFC on the back of super low interest rates, on the back of quantitative easing. If you were to ask Irving Fisher what happens at super low, interest rates, it's not necessarily that there's strong economic performance. In fact, often it's the opposite. So whether or not that's going to change the longer term trajectory of the Chinese economy, I doubt it, but it could increase asset prices in the short term, as we've seen today. So looking later on this week, we're going to see some inflation data, and those will be the key events of this week. We've got Australian monthly inflation data tomorrow. We've got US PCE data on Friday. The monthly inflation data tomorrow is expected to show a pretty big drop in headline Australian inflation, and a lot of that will be energy rebates. Whether or not we see core inflation or smoothed inflation coming down very much will be another question. Our market wants to see a drop in inflation from here. They want to start pricing in rate cuts like the US has had. So that's what they'll be looking for in tomorrow's data. I suspect the core will be the big number, and like I said, if you remove those energy rebates, if inflation comes down at all, that'll be seen as a good thing for our market. Otherwise, I think we'll see it as quite a negative reading. Moving on, for the US PCE data on Friday, that is expected to keep drifting a little bit lower as well, although not a very large amount. And again, the core data not expected to come down much at all. It does follow some weaker CPI data last month, but outside of that weaker CPI data last month, US inflation data hasn't budged since pretty much the start of the year. And, like I said, it's probably only a slight month of slightly lower data. Without that, US inflation hasn't really kept falling. Now, the Fed can say all their projections show that it's going to keep falling, and we did have a couple of bad US unemployment reads or payrolls data, but I really do think that they've placed all their belief in that they've dealt with inflation on one slightly lower reading. And like I said, there's plenty of other data points suggesting further inflation, risk asset prices, and fiscal spending being big ones. I think those will be 2 important data readings, and we could see some movement on the back of them. I suspect we'll see a slightly weaker reading for Australia tomorrow, and that could be a good thing for us. But I do think there's risk with Friday's PCE numbers coming in slightly stronger than expected, and we could see the narrative very quickly shift to whether the Fed has achieved a landing at all. Looking at the charts this week, we can see the US S&P 500 here. They reached a fresh all-time high after the rate cut, but they haven't really moved far since then. Historically, this week and next week are cyclically the worst weeks for the US market of the year. And I wouldn't be surprised to see a trough during that period. If we do see a trough, I'd probably be looking for somewhere around 5,500, maybe all the way up to sort of 5,550, but I suspect it's going to take a couple of weeks to get down there. Looking at our own market, at the XJO, I'll just quickly pause it here. And we can see that our XJO also set a new all-time high just after the Fed rate cut, and that was at 8250 index points. Over the last couple of sessions, we've come back to the previous all-time high, 8150. We've been testing that as support. If we break lower from here, I suspect we're coming back off towards 8,000, maybe even 7920. If we hold from here, I think it's going to be a bit more of a sideways grind. The sense that I get is that our market's really been pushing up into this US rate cut, and looking past the US rate cut, I don't think there's that many positives for our market. Yes, today there was a one-day spike in iron ore. Will that continue into breaking the longer-term iron ore downtrend? I'm not convinced. We've seen our banks come off a bit as well from here, and the outlook for the banks doesn't look that positive as well either, especially not given what their share prices have done. Will earnings grow very much over the next few years? Most forecasts suggest they won't. Without that US rate cut in play, what is there to be that optimistic about for our market? Hopefully a future RBA rate cut, but outside of that, it's certainly not a massive return to earnings growth for the individual shares. Like I said, if we break below 8,100, I suspect we'll be coming back towards 8,000, maybe even 79.20. If we push higher from here, I think it's a bit more of a sideways grind. So that's it for this week, guys. Hopefully you enjoyed. If you did, give us some love in the comments, click like, click subscribe, and we'll see you next time.